Interest rate hike last week, petrol prices going up, food prices expecting to go up. We have John Loos, who is the household and property strategist at FNB Home Loans, to talk about that, John. First of all, before you do, you've economized in terms of facial hair. You shaved off that magnificent moustache, which looked like it must have taken a year, but it's only November, was it?
That was November, David. Yeah, my daughter made it clear to me I was out of the house if I didn't have it off by the end of November, so it had to go.
And you really, honestly, only grew it in November?
I grew it and I won the November competition at work, yes.
And it was a
fabulous.
sort of Zapata, it wasn't just a little one, it was a
That was
big,
a proper,
yeah.
I could be a sergeant major.
Yeah. So, what do we do about this interest rate hike?
Well, I think the first thing is interest rates are still low, David. I mean, sure, the one thing one has to understand is normally when the Reserve Bank starts hiking, it's not one isolated hike. It can be, but normally it's a couple. We're not expecting an extreme interest rate hiking cycle, but the reality is, yes, at some points interest rates do go up, and there is still time to prepare for it. You can, when it comes to the cost of debt, I'm always in favor of, there's two options basically you have. I think the one is obviously to fix interest rates. Forward markets have probably adjusted their expectations now, so you probably won't get that attractive a fixed rate as you would have a few weeks ago. But the other option, which is more appealing to me as personally, is I think you should always set your debt repayments at levels of what they would be if interest rates were at relatively high levels. Now, relatively high these days by our standards is probably 15% like it was in the last cycle, and relatively low is where we are now. The problem the mistake a lot of people always make is they set all their spending levels when times are good. You should set your spending levels when times are bad or tough, relatively tough. And then when times are good, that's the bonus time. That's when you score. That's when you have extra cash in the bank, and you don't go out and blow it. You retire debt, and you do the sort of responsible things. But we're pro-cyclical. We should be more counter-cyclical.
John, what about all these products that have sort of come into market on the back of consumers being under pressure, in particular loan consolidation and that kind of thing? Is this something that one should consider putting together all debt consolidation products? Is this something that you should be latching onto when you try to bring down those debt levels?
Well, if one looks at, one of the best debt consolidation products is probably the home loan. If you're ahead of payment and you've got some to access or whatever, it normally is one of the lowest interest rates of all the debt you have. And so, but my suggestion is think of that if you've got a home loan with, 100,000 or 200,000 prepaid, as we call it, when you're ahead of schedule and you've got credit card debt and other debt with significantly higher interest rates, you can consolidate using the home loan. So there are options for debt consolidation, and yes, pick what you can to lower your overall interest rate.
Just come back to that fixing of the interest rate, because I suppose the bank does very complex actuarial and other calculations to say, so let's say you're now paying 8%. For example. Now, you're not going to get it fixed at 8% in this environment.
I don't think today you won't know.
No, but you might get it fixed at 11, say, or 12.
Yeah, it's normally your rate plus something at the moment, yeah.
And do you find people use that? And is the bank winning all the way, or do consumers win as well? Of course, if it goes up to 25%, which it did in the late 90s, then you're certainly winning.
Look, on average, I think what you've got to realize is the bank has to incur certain costs as well. It takes over your risk, your cash flow risk, and then it goes to the swap market and hedges it out. And it does an interest rate swap, and the rate it can get in the swap market is very much dependent on what rate expectations are, and they adjusted quite significantly a few days ago. The bank I guess the banking sector on average over time would gain out of the deal. It would profit something out of the deal for the service it provides. But I don't think people must see the fixed rate service that's provided as a way of beating the market. That's not the purpose of fixed rates. The purpose of fixed rates is to have cash flow certainty, or over that part of your cash flows for 1 or 2 or 3 or 5 years, and to sleep peacefully knowing that if rates do go up, if an unexpected surprise happens, is brought upon us by the Reserve Bank, it doesn't affect you.
Because if they go down, you don't benefit.
And no, I mean that's you don't lose necessarily. You maybe lose out on an opportunity, but it's for people who are perhaps more risk averse, who want that certainty, and that's the price you pay. If they go down, you lose. If they go up, you've gained. Or if you're near to the financial edge and you can't absorb any nasty surprises, you fix rate for 2 or 3 or 5 years or whatever, and that just solves that problem. So it's a service that's provided, and I think the consumer should expect to pay something for it. Yeah.
John, let's look at some practical steps that any consumer could possibly make to their normal monthly budgeting cycle, assuming that they have one, to ensure that they can try and make a little bit of saving here and there. What are some of the big things that are obvious and that we should be doing?
I suppose it depends at what level of income you are, but when you get to the middle and upper income groups, I mean, I think normally the things that go for a lot of people, if I look at the retail stats and things like that, is you probably see the restaurant eating out getting cut out, the coffee shop statistics already, the growth in those revenues have been slowing, the fast foods, it's more eat at home stuff. I mean, a lot of us with our various cell phone packages and internet bills can economize on that. So there is a lot we can do. And then, of course, the leisure, the getaways, the holidays and so on, those are luxuries. So there are a lot of places that a lot of us can economize.